Hello, and welcome to episode 114 of the REconomy Podcast, where we discuss economic issues that impact real estate, housing, and affordability. I am Odeta Kushi, Deputy Chief Economist at First American, and here with me is Mark Fleming, Chief Economist at First American. Hey, Mark. I don't know if you've heard or anything, but home sales, particularly existing home sales, have been pretty weak.
You don't say. That's been, I think, a theme for the last couple of years. We've been saying this point for the last few years. Why?
I think that's right. Yeah, I mean, ever since interest rates spiked in 2022, right after the Fed decided to increase interest rates to slow down inflation, existing home sales have not been able to break through 5 million annualized sales.
And so would you say we're in a housing recession because of it?
That's kind of a loaded question.
It is indeed.
But in my official capacity as a founding member of the HCDC, Housing Cycle Dating Committee, I am authorized to answer this question.
You know, I almost forgot about the HCDC, our version of the group that calls economic recessions, like the NBER's BCDC, Business Cycle Dating Committee.
That's right. Our housing recession equivalent of that NBER BCDC methodology is based on the following indicators. Stay with me here because there's quite a few of them.
It's a long list, listeners.
It's a pretty long list, but that's the point. It's meant to be
Right.
comprehensive. So the first one is just average hourly earnings of non-supervisory construction workers. Then we have the total number of employees in residential building construction, total number of employees in real estate, rental, and leasing, the number of single-family housing starts, private residential fixed investment, personal consumption expenditures on housing and utilities, existing home sales, and last but not least, our real house price index, which is a measure of affordability. So the way that we capture a housing recession is that we say that if the moving average of the monthly growth rate of 4 of the 8 of these indicators is negative for at least 3 consecutive months, then a housing recession has begun. So that is our sort of rule of thumb here, but based in data.
Whew, that's a long list. Call me thunderstruck, Odeta, HCDC, ACDC. I know you get it, right?
Oh, yeah. No, I get it. I get it all right.
And the eye roll to go with it. You know, I think we may have overused the ACDC references because I think we did that also in our original episode where we introduced the housing recession indicator.
Yeah, but that was way back in episode 59 in March of 2023. So we've lived a lifetime since
We could
then.
recycle at this point.
I think so. That's right.
So with over 2 more years of housing data to work with since the first introduction, back to this housing recession talk, can you walk us through what's happened to the housing recession measure over time?
Of course. So according to our housing recession indicator, the average length of a housing recession is 13 months. So that's a pretty long time. But there are a couple of notably longer exceptions that are pulling up that average. For example, the global financial crisis housing recession, that was 40 months. The GFC was a double dip recession with a 40-month-long recession from early 2006 to mid-2009 as sales and construction slowed dramatically. Then there was a brief pause, according to our measure. That pause lasted about 5 months. And then we dipped back into a recession for another 10 months in late 2009 through most of 2010, caused primarily by, you guessed it, another slowdown in construction and slower existing home sales.
I am unfortunately old enough in my career to remember those days, and they were pretty tough, the global financial crisis and the housing market. But by comparison, the most recent housing recession from May to July of 2024, very short, due to slower existing home sales, declining affordability, a slowdown in housing starts, and real estate jobs.
But so far in 2025, our measure is not telling us that we are in a housing recession.
Well, that's good, of course, but it doesn't mean that the housing market isn't struggling. We are not getting worse, but it's not necessarily getting demonstrably better, especially as we mentioned at the top of the episode, when you look at existing home sales.
Right. Consider that in February, existing home sales were at 4.26 million. I have to add that extra. The extra
there's
digit
not
there.
A third decimal to it?
I think there actually is, but for the sake of our audience, 4.26 it is. 4.26 million on a seasonally adjusted annualized basis. This is the same level of sales as during the aftermath of the global financial crisis and the late 1990s. However, comparing today's home sales to those in the past without considering the growth in the overall market size is like comparing today's apples with yesterday's oranges.
Okay, I see where this analogy might be going here. That's true. We have to consider the size of the pie, although I'm thinking orange pie.
My
Okay.
mind went to the same place. I'm like, that sounds disgusting, but maybe
Well,
someone
maybe it's a good
likes
thing.
it.
We'll go with apple pie. It makes much more sense. In our case, the pie is the number of households. So the total number of US households represents the demand for homes and is pretty much constantly growing over time.
So, an annual pace of 4 million existing home sales today is, relatively speaking, much weaker than the same number 15 years ago, given the increase in the number of households. Today, there are 132 million households compared to 112 million households 15 years ago. That's an 18% increase in demand. So, 4 million home sales now are a smaller slice of a much bigger apple pie.
So, sticking with the fruit analogy, I see,
Yeah.
we are going to, if we look at existing home sales as a percentage slice of the pie over time, sales are down to the same levels as the early 1990s, just above 3%, and well below the long run average of 4.1%.
That's a pretty skinny slice, not my kind of slice of pie.
We
So
like big
that
slices.
I think so. So that means if home sales today were tracking at the long run average percentage of total households, the pace would be about 5.4 million sales as opposed to that 4.26 I mentioned earlier. So where did more than a million sales go?
That's the really big question. Sales activity is below average because existing homeowners aren't selling for two main reasons. They're either locked into their current mortgage rates, older, and choosing to stay in their homes, or most cases, both of those things.
So, on that first point, we know that as of 2024, there were 65 million baby boomers, accounting for 20% of the US population and 36% of total homeowner households. According to a Freddie Mac survey in 2021, nearly 70% of baby boomer households felt confident that they would remain in their homes, with 68% of respondents indicating they either plan to age in place or don't have plans to move again. And according to Freddie Mac's 2019 report, seniors aging in place, otherwise not behaving as previous older generations did and aging out of their homes, that's holding back about 1.6 million homes off the market.
Okay, so there's one source of the missing slice of this pie. And the other one, of course, is the rate lock in effect. The latest National Mortgage Database data from the fourth quarter of last year reveals that 82% of mortgaged homes have a rate below 6%.
Oh.
That's a big one. But that lock in effect has actually eased substantially. If you consider the second quarter of 2022, remember when we were just sort of going into that cycle of raising rates, nearly 93% of mortgaged homes had a rate below 6%. So whether 93 or 86, the lock-in effect remains substantial.
True. Not to mention that the other piece here is affordability for potential first time homebuyers. That remains a significant challenge to entering the market.
Absolutely. That's a major hurdle as well. But I think the real issue is that existing homeowners, who, by the way, largely become buyers,
Mhm.
um, that those existing homeowners are still not selling, and slightly lower rates aren't really going to change that. But time and aging will.
As it already has, right? I mean, that lock in effect has eased, and with it, inventory has climbed higher.
Inventory and life happens. Sometimes you just need to move, be it for a career change or a lifestyle change. Moreover, a lot of these homeowners are sitting on substantial home equity, so they can offset higher interest rates by bringing down a higher down payment to the closing table.
That's a great point. So, we also know that home sales are not just made up of existing homes or used homes, I guess,
Used homes,
as you
right?
like to call them, but
We're the
also
only
new
we're the
homes.
only country that calls them existing.
Yes. Well, if we
Yeah,
have new homes, it makes sense to call them used homes or old
exactly.
homes, I guess. But according to our latest analysis, existing homes made up 86% of total home sales in February, while new home sales made up about 14%. So the biggest chunk does come from existing homes, but you can't leave out that new home component as well.
That's right. So, using a similar analysis of apple pie or apples to oranges, we find that the relative sales of new homes has also declined. The number of new home sales as a percentage of the pie over time has fallen to the same levels as, again, the early 1990s, about 0.5%, and well below the long run average for new homes of 0.7%.
And if new home sales were tracking at that long run average percentage of total households, the pace would be almost 950,000. But the reasons for this decline are a little bit different from the existing home market.
That's right. Builders, of course, face less competition due to the chronic housing shortage made worse by the sellers' strike. They are not living in those homes that they're building, but their construction costs have increased significantly. Compared to pre-pandemic residential construction costs, they're up more than 40%. Financing costs are also higher for builders, so it's getting more expensive to build.
Not to mention that builders have had to navigate regulatory restrictions, a chronic skilled labor shortage since the global financial crisis, and lot shortages, making it difficult to scale up construction to meet growing demand, let alone reduce the overall housing supply shortage that we've been accruing over time.
That's right. All unfortunately true. So when we put this all together, we find that in February, total combined home sales were 5 million seasonally adjusted annualized sales, or 3.7% of the total household pie, which is 1.1 percentage points below the historic pre-pandemic average for total sales of 4.8%.
And if total home sales were tracking at the long run average percentage of total households, the pace would be closer to 6 million. So we're at 5, it should be closer to 6, given that historical comparison.
That's a
Other
lot of
than
missing sales.
it's a lot of missing sales, and we feel it, right? Everyone in the housing industry can feel that. Other than the brief dip in 2010 due to the expiration of the first-time homebuyer tax credit, this level of sales activity as a share of total households is similar to the early 80s.
Okay, Odeta, I cannot let this go. Of course, you mentioned the 80s. I love it when a plan comes together.
Did you just quote the A-Team?
I did indeed. And you know what? I'm impressed that you picked up on that. Now, that was must-see TV. Back-to-back decadal references here. I'm guessing you know this latter one as well, Odeta, or maybe more so than the A-Team.
First of all, I only know the A-Team because of you, because we've been in the office together long enough for you to reference. I love it when a plan comes together and then tell me where it's from. But
Every time.
every time. But I'm also of the Friends generation, so of course I know what must-see TV
There
is.
you go.
But, before we close the episode, I want to mention that this analysis can be repeated for inventory as well as sales. And in fact, it should be, right? When we call our household adjusted inventory measure inventory turnover. In February, total, new and existing inventory turnover was 1.4%, or 140 in every 10,000 homes were for sale. Historically, it would be more like 250 in every 10,000 homes were for sale.
So still well undersupplied in terms of inventory from a historical perspective.
That's right, but it's an improvement from where we started 2024 at 123 in every 10,000 homes were for sale. That increase in both new and existing home inventory should allow for more sales to happen.
That's right. You can't buy what's not for sale, but luckily, home inventory is modestly rising, and therefore sales activity should slowly follow.
But all of the things we mentioned over the episode will continue to hold back market activity from its potential. The lock-in effect, affordability constraints, aging in place, and for the builders, rising costs, supply-side constraints, and higher financing costs.
Womp womp. Debbie, downturn again.
You know what? I think I'm more like a Rebecca realist or something.
Yeah. No. Doesn't roll off the tongue the same way.
Okay, actually really doesn't.
No.
Okay, well, when we're trying to assess the health of the housing market, this episode should hopefully show you that it's important to account for the size of the pie. I mean, households. And
That's
that's
right.
it for today's episode. I think we're going to go grab some apple pie probably. Thank you for joining us.
Should we try and make an orange pie? Is there such a thing?
You can take that task on yourself, but I'm going to skip the orange pie.
I do like apple pie, so we're good to go. Yeah.
That's where we're going. Thank you for joining us on this episode of the REconomy Podcast. If you have an economics-related question you'd like us to feature in the future, you can email us at economics@firstam.com. And as always, if you can't wait for the next episode, you can follow us on X. It's at Odeta Kushi for me and at Fleming Econ for Mark. Until next time.